Welcome. Today, we're diving into the world of interest rates, a term you've probably heard countless times, whether on the news, at the bank, or in conversations about loans and savings. But what exactly are interest rates and why do they matter so much in our daily lives? In this video, we'll break down the basics, explore how interest rates work, and see how they affect everything from your savings account to the cost of borrowing money. Let's start by understanding the core concept of interest rates and why they're so important in the financial world. At its simplest, an interest rate is the cost of borrowing money or the reward for saving it. When you borrow money from a bank, you pay interest, a percentage of the amount you borrowed. On the flip side, when you deposit money in a savings account, the bank pays you interest as a reward for letting them use your funds. This percentage is what we call the interest rate. It's a fundamental concept that underpins much of the financial system, influencing everything from personal loans to national economies. Interest rates exist to compensate lenders for the risk of lending money and for the opportunity cost of not using that money elsewhere. For borrowers, interest is the price paid for accessing funds they don't currently have. For savers, it's an incentive to deposit money with a bank rather than spending it immediately. This balance helps keep the financial system running smoothly, ensuring that money flows where it's needed most. Interest rates are usually expressed as a percentage of the principal, the original amount of money borrowed or saved, over a specific period, often annually. For example, a 5% annual interest rate means you'll pay or earn 5% of the principal each year. This makes it easy to compare different loans or savings products and understand the cost or benefit over time. There are two main types of interest: simple and compound. Simple interest is calculated only on the original principal, while compound interest is calculated on both the principal and any interest already earned or paid. Compound interest can make a big difference over time, especially for long-term savings or loans, as it allows your money to grow or your debt to increase faster. Let's look at a quick example of simple interest. Suppose you deposit $1,000 in a savings account with a 3% simple annual interest rate. After 1 year, you'll earn $30 in interest, 3% of $1,000. The next year, you'll earn another $30, and so on. The interest doesn't compound, so your earnings stay the same each year. Now let's see how compound interest works. Using the same $1,000 at a 3% annual compound interest rate, after the first year you earn $30, but in the second year you earn interest on $1,030, not just the original $1,000. This means your interest grows each year, and over time your savings can increase much faster thanks to compounding. Interest rates play a crucial role when you borrow money, whether it's for a car, a home, or a personal loan. The higher the interest rate, the more you'll pay back over time. That's why it's important to shop around for the best rates and understand how much a loan will really cost you in the long run. On the flip side, interest rates also determine how much you earn on your savings. A higher interest rate means your money grows faster in a savings account or certificate of deposit. That's why people often look for accounts with the best rates to maximize their returns. Interest rates aren't set at random. Central banks, like the Federal Reserve in the United States, play a major role in determining the base interest rates for an economy. Commercial banks then use these rates as a reference when setting their own rates for loans and savings products. Central banks are government institutions that manage a country's currency, money supply, and interest rates. By raising or lowering the base interest rate, they can influence economic activity, encouraging borrowing and spending when rates are low or slowing things down when rates are high. Interest rates change in response to economic conditions. When the economy is growing too quickly and inflation rises, central banks may increase rates to cool things down. If the economy slows or faces recession, they might lower rates to encourage borrowing and investment. Inflation is the general rise in prices over time. When inflation is high, central banks may raise interest rates to make borrowing more expensive and slow down spending. This helps keep inflation in check and maintain the value of money. Interest rates have a powerful impact on the overall economy. When rates are low, borrowing is cheaper, which can boost spending and investment. When rates are high, borrowing costs rise, which can slow down economic growth. Central banks use this tool to help manage economic cycles. Interest rates on loans and savings can be fixed or variable. Fixed rates stay the same for the entire term, making it easier to plan your payments or returns. Variable rates can change over time, often in response to changes in the broader economy or central bank rates. Imagine you take out a fixed-rate mortgage at 4%. Your interest rate and monthly payments stay the same for the life of the loan, no matter what happens in the economy. This predictability can be helpful for budgeting and long-term planning. With a variable-rate loan, your interest rate can go up or down over time. If rates rise, your payments may increase. If rates fall, you could pay less. This flexibility can be beneficial, but it also introduces uncertainty into your financial planning. When comparing loans or credit cards, you'll often see the term APR, or annual percentage rate. This figure includes not just the interest rate but also any fees or additional costs, giving you a clearer picture of the true cost of borrowing. Credit cards often have higher interest rates than other types of loans. If you carry a balance from month to month, you'll pay interest on that amount, which can add up quickly. That's why it's important to understand your card's rate and try to pay off your balance in full whenever possible. Mortgages are long-term loans used to buy homes. Even a small difference in the interest rate can mean thousands of dollars more or less paid over the life of the loan. That's why shopping for the best mortgage rate is so important for homebuyers. Car loans are another common type of borrowing affected by interest rates. The rate you get can depend on your credit score, the length of the loan, and market conditions. Lower rates mean lower monthly payments and less paid overall. Student loans often have different interest rates depending on whether they're federal or private. Federal loans usually offer lower, fixed rates, while private loans may have higher or variable rates. Understanding these differences can help you manage your education debt more effectively. Businesses also borrow money to grow or manage cash flow, and the interest rate on a business loan can affect profitability. Lower rates make it easier for businesses to invest in new projects, hire employees, or expand operations. Interest rates also influence investments like bonds and stocks. When rates rise, bond prices usually fall and vice versa. Stock markets can also react to changes in interest rates as borrowing costs and consumer spending are affected. Interest rates can affect a country's currency value. Higher rates tend to attract foreign investors, increasing demand for the currency and raising its value. Lower rates can have the opposite effect, making exports cheaper but imports more expensive. Expectations about future inflation can influence current interest rates. If people expect prices to rise, lenders may demand higher rates to compensate for the reduced purchasing power of money in the future. Nominal interest rates are the stated rates you see on loans or savings accounts. Real interest rates adjust for inflation, showing the true increase in your purchasing power. For example, if your savings earn 4% but inflation is 2%, your real return is 2%. To get the best deal, it's important to shop around and compare rates from different banks or lenders. Look at the APR, fees, and terms to make sure you're getting the most value whether you're borrowing or saving. There are many online calculators and comparison tools that can help you evaluate different interest rates. These tools make it easier to see how much you'll pay or earn over time, helping you make smarter financial decisions. Interest rates can go up and down over time depending on economic conditions, central bank policies, and global events. Staying informed about trends can help you decide when to borrow, save, or invest. Understanding interest rates is key to managing your personal finances. Whether you're taking out a loan, using a credit card, or saving for the future, the rate you get can make a big difference in your financial health. Interest rates play a big role in retirement planning. The rate you earn on your savings and investments can determine how quickly your nest egg grows, while the rate on any debt affects how much you need to pay off before retiring. When buying a home, the interest rate on your mortgage can have a huge impact on your monthly payments and the total cost of your home. Even a small change in rates can mean big savings or extra costs over the life of your loan. Keeping your emergency fund in an account with a competitive interest rate helps your money grow while staying accessible. Look for high-yield savings accounts or money market accounts to make the most of your emergency savings. If you have multiple debts, paying off those with the highest interest rates first can save you money in the long run. This strategy, known as the avalanche method, helps reduce the total interest you pay over time. Your credit score can have a big impact on the interest rates you're offered. Higher scores usually mean lower rates, saving you money on loans and credit cards. Keeping your credit healthy can pay off in the long run. Interest rates are a key tool for managing economic growth. By raising or lowering rates, central banks can influence how much people borrow, spend, and invest, helping to keep the economy stable and healthy. Interest rates in one country can affect markets around the world. Investors move money to countries with higher rates, impacting exchange rates, trade, and global investment flows. That's why central bank decisions are closely watched worldwide. Governments borrow money by issuing bonds, and the interest rate they pay affects the cost of financing public projects. Lower rates make it cheaper for governments to borrow, while higher rates increase the cost of debt. Interest rates touch nearly every aspect of our financial lives, from the cost of a cup of coffee bought on credit to the returns on your retirement savings. Understanding how they work can help you make better choices every day. Smart financial planning involves keeping an eye on interest rates. Whether you're deciding when to refinance a loan, open a new savings account, or invest, understanding rates can help you make the most of your money. Higher interest rates often come with higher risk, especially for borrowers. Lenders charge more when they think there's a greater chance they won't be repaid. Understanding this relationship can help you assess the true cost of borrowing. When you lend or invest money, the interest rate represents the opportunity cost, the benefit you could have received from using your money elsewhere. That's why comparing rates is so important before making financial decisions. From savings accounts to mortgages, credit cards to business loans, interest rates are a key feature of nearly every financial product. Understanding how they work can help you choose the right products for your needs and goals. Wrap up: interest rates are a fundamental part of the financial system, affecting everything from personal savings to global markets. By understanding how they work, you can make smarter decisions about borrowing, saving, and investing. Whether you're managing debt, planning for retirement, or just trying to get the best deal, keeping an eye on interest rates can help you achieve your financial goals.